long as we get the information, right? Trading, the ultimate language is in the price, which is what I love about the markets, right? And whether it's Wyckoff or Wyckoff, I don't really get too concerned about that. I really want the concept here. And really what we're talking about here today, guys, the idea of overbought and oversold. And it's timing. Everybody put in the word timing here. Timing. When to buy, when to sell. Noah, walk us through the phases, walk us through the cycle, and then let's take one or two examples and go and actually really, dig into this principle here.
Well, if you look at it from just a psychological standpoint, there's really quite a bit of brilliance here. And I think that's what the sign of genius is, and give hats off there, is the ability to simplify a concept that's seemingly complex. If you can explain it to a 5-year-old. And you think about it from this perspective, as prices are dropping, how many of you like the idea of buying a dropping price? We like discounts, we like bargains, but if the price is still moving down, how many of us are afraid to step up and be the first ones to buy? We should be, because we oftentimes talk about that. We need to wait for confirmation and don't catch a falling knife and things like that. And so when prices are coming down, it's always scary to buy, and the institutions do this because they have deeper pockets than most traders. They'll cost average their way down and they'll cause the support. Institutions can, I'd say a support is an institutional footprint. But as prices are coming down and it's getting cheap, we like the price, but we don't like the direction of the trend. And so when we see prices have gone down too far, I think it's general human nature, Tim, that people panic. They get scared, they sell. And when they get scared and that fear and greed are kicking in, the bears are greedy, and the bulls are fearful. You'll see prices drop to a point where prices have probably gone too low, and so that's why we call it oversold. And this is where you'll see institutions start picking it up at the cheap prices, and it's called the accumulation phase. And so, from early in my trading, I was taught to wait for that confirmation, which is kind of a funny thought if you think about it. Like, prices come down, and that's a great deal, and then you wait for the prices to go off sale so you can pay more up here. It's a really smart idea because it makes sure that the prices are moving back in the direction of the trend or coming off and forming support. But that, being able to spot a stock when it's oversold is really, really, I think, important for having a good sense of timing. And then, being able to step up and be an early, buyer is I think one of the keys to success. Not too late. You don't want to wait too long. And if you wait too long, prices will run up. And by the time people are talking about that stock around the water cooler, saying how awesome their profit was, what do you think it's in their mind to do after prices have run up?
Mm-hmm.
They're looking to get out, and so they call this the dumb money will come in late and buy stuff when it's really, really overbought. And so right now I'd say the market's in an overbought scenario. It may continue to trickle higher, and that's why it's kind of that curve, because you never really know where that tipping point's going to be. But accumulation is just a fancy word for buying, and distribution is just a fancy word for selling. But this concept, it works on all time frames. I mean, you think that the psychology of a day trader is really much different than the psychology of a swing trader? I mean, they're both human beings. They both have the same general brains. The only difference, I think, is how quickly they're pushing the button. But even in a long-term investor, they still have that same psychology of trying to buy low and sell high, but their time frames are different. Their psychology is similar, but the time frames are different. And so,
and there's let me jump in here for just one moment because I think it's really great. And I did see a good comment come in here from Blake and Cecilia. And hello, Blake and Cecilia. Good to see you guys. Nice to meet you out there last weekend. They say when everyone is selling, we should be buying. When everyone's buying, we should be selling, or something like that. Now, I wish it was that easy, right? I mean, it's just, the mindset, I think we all understand it. When everybody is fearful, you buy. When everybody is, greedy, you're going to get rid of it. You're going to sell. And this is where timing comes in. So I do want to go through each one of these different definitions and kind of examine them thoroughly and really dig into it. During the oversold phase of a condition, whether it's a 15-minute chart, a 1-hour chart, a daily chart, an investor chart, what is it we should be watching for and doing when we are in oversold conditions and accumulation phase, Noah?
First thing I'm going to look for is a price level that is of interest, a support zone,
Okay, let's write that down.
a
I love it.
catalyst, yep,
Okay,
price
guys,
level.
in your notes, make sure you're putting down accumulation phase or oversold or both, and then put support zone because I agree with that. That was what I was looking for, Noah, and go with that for a minute.
Yep. And so you get a price level where you think about it. If you know that old resistance could become new support, for example, isn't there already a built-in expectation that that's a place to buy? And so you look for those price points, those price levels, or those catalyst points where you expect traders to buy. And then you can look for the additional signs and signals like the slowing momentum of the candlesticks, the direction of the close. You know, if it closes down, this is something that I learned from. Oddly enough, the question came in whether to use the RSI or the stochastic. Well, the stochastic was developed by a guy named George Lane, and my mentor Jeff Crystal met George once upon a time and picked his brain. And he basically explained it to him that he said, look, professionals are either buying or selling. And if the price is closing down and the price is closing lower and the price is closing lower and the price is closing lower, what are the professionals doing? The professionals would be selling. And then when we see the price close higher, now what do we know about what the professionals are doing? They're buying. And so the same thing, the price will tend to trend in the direction of the close because that's the amateur hours, the open of the market, the closing hours. Everybody else has a day job except for the professionals, and so it'll close higher, and close higher. And as long as it's closing higher, we know that the professionals on average are still buying. And then of course you get some amateurs out there here, and you get some amateurs down here. Even sometimes professionals will fade the market, but it's not a beginner's game for sure.